following slides I'm going to go into detail about basically not every retirement plan, but the most popular retirement plans that may be available for your practice. So again, some of these I'll touch on in greater detail, others I won't, but going to get started by talking about the different retirement plans and what the contribution limits are for the individual participants. This means the individuals that are your employees as well as yourselves, right? So with a SEP IRA, no individual employee is allowed to put their own money into that type of plan. Only employer contributions are allowed. With a simple plan, you're able to put away up to $17,600 as long as you have under 25 employees working for your practice. If you're over 50 years old, there are various catch-up provisions which could allow you to put away even more money into these type of plans. Another great option is a 401k plan, and with a 401k plan, there's employee contribution limits of $23,500 with, again, additional catch-ups if you're over 50 years old, where you could put away over $30,000 of the money that you're making into that retirement plan. A profit-sharing plan, defined benefit plan, there's no employee participation rules, participation amounts allowed. So those are just going to be employer-provided contributions. So to talk about the employer side of things, with a SEP IRA, that is discretionary. However, it must be the same percentage for every employee that you have. So with the SEP plan, that could be a great retirement plan for a practice. However, once you have employees that are eligible to participate in that SEP plan, now it doesn't become so attractive, because if you're putting away 25% of your own salary into a SEP plan, now you have employees that are eligible, you have to put 25% of their salary into that retirement plan as well. So a lot of dentists we work with are very, very generous with their staff. None of them that I've ever met are that generous, where they want to put 25% of what every employee makes into their retirement plan. With the simple plan, basically you'll be getting a 3% dollar for dollar match of their compensation based upon how much they put into the plan. So again, for a lot of new, younger dental practices just starting out, younger owners, not extremely profitable yet, a simple plan could be a great alternative to a SEP plan, because instead of having to put away almost 25% of someone's pay into a retirement plan, now all you have to do is a maximum of 3%, and that's a matching contribution. So if your employees, and generally speaking, especially a lot of the lower income employees, they're going to put 0% of their pay into a simple plan, right? So by setting up that type of plan, it's going to limit the cost that you're going to incur there. 401k plan, depending upon the type of plan, it's usually discretionary unless a safe harbor provision applies. Profit sharing plan, same thing there, also going to be discretionary, the employer's contribution. And with a defined benefit plan, which is very different from a 401k plan, and those are usually the two more sophisticated plans for more established practices that you're going to want to implement. Those are determined with the help of a pension plan actuary and various calculations. So the next slide covers whether or not after-tax contributions are allowed into these type of plans. So with a SEP plan, Roth options are actually now available. This was a change that was made, I believe, back in 2022. So a SEP plan, you actually could put Roth contributions into the plan. With a simple plan, Roth contributions are now also allowed as well. And with the 401k plan, the same is true there. With all these plans, you just want to double check with your plan provider to see if your plan allows for Roth contributions. With the 401k plan, that was always an allowable rule as long as your plan document called for that. But with the SEP and a simple, you never used to be able to do Roth contributions up until about 3 years ago. So definitely want to talk with your plan actuary, whoever's managing your business retirement plan, to see if a Roth contribution is allowed into that plan. Profit sharing plan, defined benefit plan, those do not allow for Roth contributions. Now, the following is what the maximum contributions are both for each of these plans between both the employee and the employer. So again, depending upon your facts and circumstances, this could give you a gauge of which plan is going to make the most sense. So with a SEP plan, it's the lesser of 25% of your compensation. If you're an S corporation, that's your W-2 wages. If you're any other entity type, it's your end-of-year business profit. So it's the lesser of 25% of your compensation or $70,000. For a simple plan that provides the 3% match, that limit is basically going to be $35,200 or $42,900 if you're over 50 years old. With a 401k plan, it's once again the lesser of 100% of your compensation or $70,000, whichever's lower. And if you're over 50 years old, you get an extra $7,500 catch-up. So you could be putting away up to $77,500 per year. Same exact rules apply with a profit-sharing plan. And then again, with a defined benefit plan, that is going to be determined with the help of a retirement plan actuary. Again, we have dentists that are in their late 40s, 50s, making very good income. They're able to put away by combining some of these plans, 401k with profit sharing and defined benefit. Some of them are able to put away $100,000 a year, $200,000 a year, $300,000 a year, sometimes even $400,000 or more a year into their retirement plan and receive a full tax deduction for doing that. That could save you $200,000 in taxes in that year. So definitely something you want to be looking at. And again, same as I mentioned with entity choices, you want to be looking at this with your accountant every year, making sure you have the most appropriate entity in place. But the same is true with retirement plans, because what may have made sense for you in 2024 may not make sense in 2025, and maybe a different plan makes sense in 2026. So if you're not looking at this every single year, you really should be. You want to make sure you're talking with your accountant, going over this stuff, as well as your financial advisor each and every single year.